All right, with us now, Kevin Hassett, former chair of the Council of Economic Advisors, distinguished fellow at the Hoover Institution, and author of the most important book of the century. It's called The Drift, about stopping socialism. Kevin, you're almost developing a perfect storm here. You had another bad inflation number today. Import prices up 0.4 in March after 0.3 in February and 0.7 in January. You know all about inflation over the past 3 months. CPI about 4.5% at an annual rate. What's going on here, Kevin Hassett?
Right. Well, it's going exactly the way you and I have been saying it would go for the last 2 years, really all the way back. I went back and looked. It was September 2022 when we started to talk about the 10 steps to stagflation, and we're stuck at step 8, which I just wrote about at National Review this week, which is that price inflation and wage inflation stick together. Price inflation doesn't go below wage inflation, and right now they're both running between 4.5% and 5%, way above the Fed's target. I think that in January, I remember once you asked me on the show, Kevin, is there going to be any rate cut this year? And I said no. And I think the market now sees that that's probably true. But my guess is that you're going to have to see rate hikes. Inflation is accelerating so much. And if there's some uncertainty in the Middle East, then that's going to drive energy prices up even more. That's going to create serious pressure on the Fed to go up maybe as much as another percentage point if you look at the sort of rules of thumb about where interest rates should be right now, given inflation.
You know what's interesting about that point, and we've been talking about that on the air, Breitbart's John Carney, myself. Larry Summers, I think, started this when he said there's a non-zero probability that the rate hike will be the next move. And then our dear friend Larry Lindsay was writing back in 2016 when Janet Yellen was Fed chair. She raised rates right after the election at the December meeting. And so the question, Kevin, is, might history repeat itself? Be tough for them to raise rates. I mean, Biden was out yesterday, and I think he may have repeated it today, that he expects the Fed to cut rates. He just didn't know what month. But maybe they'll wait. But the next move might be higher rates after the election.
Right. I think that especially if Trump wins, I think that rate hike, I think President Trump always felt like Janet Yellen was being partisan at the Fed, and it's one reason why he didn't reappoint her. And I think in retrospect, she probably was, right? And so I think what the Fed should do is ignore politics, look at the data. If you do that, then right now you should hike, not cut. And there's really nothing I can see in the data that would lead to rate reductions unless something like a black swan event, like the Middle East got way, way worse. And it turned into a hot war between Israel and Iran or something. If that were to happen, markets would drop 20, 30%, and then the Fed probably would start cutting rates. But I think absent a really big black swan event, then the data are really out of control on the upside. Larry Summers is right about that. You know,
Kevin, the last point I want to make is you're still seeing a tremendous rate of government spending. I mean, so much of the GDP is coming out. Government spending into consumers, increasing demand, but we're not increasing supply. Business investment is virtually flat. And so they're still doing it, Kevin. The number came out earlier this week. The first half of fiscal 24, 6 months in, you're running $1 trillion deficit. Okay, and it's not lower revenues, it's higher spend. So we could hit $2 trillion again. That's an inflationary pressure. From a president who wants the Fed to drop rates, he's really causing inflationary pressures.
Right, and over the next decade, the CBO now says that debt held by the public is going from $26 trillion to $48 trillion.
Right.
Think about it, all the way to $48 trillion. And that big increase in debt, you know where it leads. It leads to inflation. Yeah. And in fact, if the Fed doesn't inflate that away, then the country might have to default out its debt. I mean, that's so much debt, $48 trillion, that it puts an unbelievable amount of pressure on the Fed. And my guess is that what's going to happen after the next election is that Congress is going to have to rebalance those things, because there's just no way the U.S. could be on this path to Weimar Germany and stay on it for another decade the way the CBO projects.
You're right. It's a major policy change going to be necessary. Kevin Hassett, thank you ever so much.